Hello, Professor Barati here. I want to go over a statement of cost of goods manufactured problem that I think will help you not only in preparing the statement, but what I'd like to go through is the logic. And what's important about the logic is the statement basically is a template that you could always create and save on an Excel spreadsheet, or go back to the book, or even go online anywhere and Google the statement and get the format and just copy and paste it. What I want to embed here is what the statement is all about and the logic behind the statement, so that you understand not so much the presentation, because as I said, that's simply cutting and pasting a spreadsheet with all the formatting. But what I want to instill in you is that the logic is quite simple and easy to follow. So what might appear to be a complex statement really is not. So what I want to do is present this problem to you. And the reason why I chose this problem is because this problem, according to our text, is CMA adapted, meaning that you're likely to find a problem like this on the CMA exam, which is a Certified Managerial Accounting exam. Not as prestigious as the CPA, but it's basically the manufacturing sector response to a CPA, and it is quite a challenging exam. So let's introduce the problem. And again, once you see how relatively easy this problem is, and that the fact that it's CMA adapted might give you a little confidence that these problems are not really that difficult. So here we go. Norton Industries, a manufacturer of cable for heavy construction industry, closes its books and prepares financial statements at the end of each month. The statement of cost of goods sold for the prior month, April, is as follows. So it gives you your inventory balances, cost of goods manufactured, cost of goods sold as of April 30th. But we have to prepare one for May. Additional information. Of the utilities, 80% relates to manufacturing cable, 20% relates to the sales and administrative function. Very simply put, we're going to take 80% of the utilities, which will be considered manufacturing overhead, into the statement of cost of goods manufactured, and 20% of those utilities will be in the selling and administrative section of the income statement. All rent is for the office building, so that will be presented on the income statement as selling and administrative expense. Property taxes are assessed on the manufacturing plant, which means property taxes will be considered manufacturing overhead, and that will appear on the statement of cost of goods manufactured. Of the insurance, 60% is related to manufacturing, 40% is for sales and admin functions. So again, we're going to take the insurance number, take 60% of that, include that as manufacturing overhead in our statement of cost of goods manufactured. We're going to take 40% of the insurance and allocate that to sales and admin section of the income statement. Following the inventory balances as of May 31st are right here presented: direct materials, WIP, and finished goods. Depreciation expenses as follows: for the manufacturing plant, $20,000, manufacturing equipment, $30,000, office equipment is $4,000. So right off the bat, you know 20,000 and 30,000 will be included in the statement of cost of goods manufactured as manufacturing overhead, and 4,000 will be included as office equipment and selling and admin expense on the income statement. Then Norton gives us pre-closing account balances as of May 31st. So basically this is a trial balance. It's giving us balances in its chart of accounts via a trial balance for all its balance sheet and revenue and expense related accounts. So our job is to decipher or delineate which accounts are relevant and which accounts are not. So we go down this list and we're going to be basically picking the relevant accounts for the statement of cost of goods manufactured and the relative accounts for our income statement. Requirements are statement of cost of goods manufactured and 2 income statement for Norton in May. So before I just give you the presentation and where all the numbers go, let me just explain what the statement of cost of goods manufactured really is. All it is a statement that takes the debits and credits or the cost flow of debits and credits that go through our manufacturing inventory T accounts. So the debits and credits going through direct materials, the debits and credits going through WIP, the debits and credits going through finished goods, and eventually into cost of goods sold, are basically taken out of the T accounts or our chart of accounts and put into this statement of cost of goods manufactured. That's all this statement is just basically a representation of costs flowing through our 3 inventory accounts into a statement. And I will show that to you via T accounts. But let's just go through the statement of cost of goods manufactured. Our first section is to look at direct materials used. Basically, the problem tells us you start with your direct materials inventory, which the problem gives us. Right here. So our T account would look something like this. Beginning balance for direct materials of 28. Next, the problem says to include direct material purchases of 510. That's in your pre-closing account balances of 510 right here. So if you were to create a journal entry or an accounting system, would basically take the purchases for the month for direct materials and debit direct materials inventory. These are inventory accounts. Next step on the statement of cost of goods manufactured is you're going to add in freight. So freight is, as we know, is part of GAAP, the freight of transporting inventory in, whether it's a manufacturing company or a retailer or a distribution company. We include freight as the cost of the materials. So we have to take the freight for materials and add that into our direct materials inventory. basically, these three items gives us direct materials available for production use. Direct materials available, really doesn't matter what you call it, as long as you basically say that it's available for some kind of use of production. So these three numbers added together, beginning balance, direct materials, plus purchases, plus any freight in, is going to equal your direct materials available for use. Now, we must subtract our direct materials ending inventory on May 31st, which is given to us right here, 23K. So your T account for ending inventory is given to us in the problem as 23,000 as of May 31st. That means the credit side is going to be right from the statement $530. So the credit side is going to be $530. So 553 minus 530 is 23. This 530 is direct materials used for production. So the credit to your direct materials T account that's needed to balance to your ending inventory balance is essentially the line item on your statement, direct materials used for production. Right here. Now we all know that the credit to direct materials inventory is made because that's the direct material that was used in WIP. So a credit to direct materials inventory is a debit to WIP. That materials was put into production and is now work in progress. So it's a debit to WIP. Next, we start putting in our direct labor wages, which is given to us as $260, and it's right in the problem. Direct wages of $260 is direct labor of $260 right there. Our beginning WIP inventory is given to us in the problem on April. Work in progress April 30th, that's our beginning May inventory of $150. Direct labor, for those of you who want to jump to the job costing or entries, direct labor goes straight into WIP inventory. So it's a debit to WIP and it's a credit to wages payable and so on. The direct labor is given to us right in the problem as $260. Next, we have to add in our manufacturing overhead. Now, not to complex it so much, but manufacturing overhead, it's assumed here, It could be applied or actual. It's not important when you're doing the statement. What's important is what you debited WIP for. But let's just say, for argument, to be technical about it, the debit to WIP for manufacturing overhead is applied. So it's based on a predetermined rate of whether it's based on direct labor hours or machine hours. So let's assume we did that step already. So it's a debit to WIP and a credit to manufacturing overhead applied. So let's analyze our manufacturing overhead. So the problem basically is given to us here. It's taking indirect labor, utilities, insurance, and depreciation. So indirect factory labor is right in our information given to us in our chart of accounts or pre-closing accounts. So indirect factory labor is 90. Utilities. Now remember, the problem stated at the beginning that 80% of utilities are manufacturing related. So let's find our utilities number, which is 135, and multiply that by 80%, which will be 108, which is what they have here. So we'd be debiting utilities for 108, and that is 80% of utilities. Property taxes, plant. The problem said that all property taxes are manufacturing related. Property taxes are assessed on the manufacturing plant. So let's go to our chart of accounts or our trial balance and see our property tax number is 60. So we take all of that number. Insurance is another allocation. In the problem they said that insurance is 60% is manufacturing, 40% is related to sales and admin. So insurance is 60%. So let's go to our insurance number of 20. Multiply that by 60% and we get 12. So we'd be debiting WIP for 12, crediting manufacturing overhead applied for 12. And that's what we have in the statement. Depreciation. They broke depreciation down for us, I believe, right here. So we know the manufacturing depreciation for the plant and manufacturing depreciation for the equipment go into our debit as a WIP in the WIP account. So that's 50. And going to our statement, that's what we have. So total factory overhead is 320. And when we add these up, you'll see that it is 320. The next step is to get to total manufacturing cost. Total manufacturing cost is just going to be the manufacturing costs incurred for that period. It's not going to include beginning WIP. because beginning WIP came from a prior period. Some of you may see this term called, some of you may also see the term called total manufacturing costs to account for as another definition for this line item. But it's total manufacturing costs incurred for the period. You could even call it that. Remember, this is not a GAAP statement. It's more for internal use. And it's basically designed to show the flow of costs through the inventory accounts via debits and credits. So, essentially, our total costs for manufactured in the period of May is going to be 1110, which is the sum of our direct materials used plus direct labor plus all the manufacturing overhead items. So this section of your T account is going to equal your manufacturing costs incurred for the period, or total manufacturing costs. Now, we take the work in process inventory from the beginning of the period, which is given to us in the problem, right here, and we add it to total manufacturing costs incurred for the period to get to total manufacturing costs to account for. So all of these then, the whole debit side of your WIP is basically going to be your cost of goods, manufacturing costs to account for. Now, we're told that our work in process inventory at the end of the period is 220, which we got right here. So our ending inventory is 220. That means 1260 minus something has to get us to 220. We need to put a credit there. The credit on the WIP inventory T account or chart of accounts, whatever you want to call it, the credit this side to balance your beginning plus your manufacturing costs for the period minus your ending WIP. This side, the credit, is going to be your cost of goods manufactured. So that number is right here, the 1040, but you could have got that by just doing the math. So our debits are 1260. To get to ending inventory of 220, we need a credit of 1040. So a beginning WIP plus all your manufacturing costs incurred for the period minus what was completed and transferred to finished goods is going to be your ending balance. This essentially becomes your cost of goods manufactured. Credit WIP, debit finished goods. So the credit to your WIP account is always going to be your cost of goods manufactured. what I'm trying to show you, the logic here is you don't even, when we're done with T accounts, you don't even need to have all these givens. You don't even need to have all this information. You could essentially prepare a statement of cost of goods manufactured right from these T accounts. Okay, you would have beginning balance, direct materials. Add purchases, add freight equals direct materials available for use. Minus ending inventory balance equals direct materials used for production. Add direct labor and the manufacturing overhead gives you costs manufactured for the period. Add in your beginning WIP balance plus your direct labor and manufacturing overhead gives you costs of goods account for. Minus your ending WIP inventory is going to give you your cost of goods manufactured. So you literally can prepare the statement of cost of goods manufactured right from the T accounts. So there is your cost of goods manufactured. Now your beginning finished goods inventory is given to us in the problem as 247. Our ending finished goods inventory is 175. So, if we take our cost of goods manufactured, we add that to the beginning finished goods balance of 247. These two numbers together gives us cost of goods available for sale. And there it is. Now, the ending inventory for finished goods is 175. That means beginning plus the debit to finished goods that came over from WIP, the cost of goods manufactured, minus ending inventory is going to give us the credit we need to balance. So 247 plus 1040 equals our cost of goods available for sale on our income statement, minus 175 gives us the credit that we need to balance. This credit is your cost of goods sold on your income statement. Credit cost of goods sold, credit finished goods, and debit cost of goods sold. Right there. So essentially, you can do your statement of cost of goods manufactured right from these T accounts. You could take this whole section here and prepare this schedule right from your T accounts. Direct materials beginning inventory is 28. Purchases 510. Freight in 15. Direct materials available is going to be the sum. Direct materials ending is going to equal your ending direct materials. Direct materials used is going to equal direct materials available minus ending 530. Now, this represents essentially your debits to the WIP account right here. So let me highlight that for you. Direct labor wages is going to equal your debit right there. Indirect labor utilities, property, insurance, and depreciation. Total factory overhead is the sum of your manufacturing overhead items that were just debited. Total manufacturing cost is going to be the total of your debits that were made to your WIP account. So total manufacturing cost is going to be your wages, your materials used, your wages, and your overhead. So let's see, I didn't get the right answer there. Let's see what we did wrong here, just temporarily. Oh, I double counted the overhead, sorry. So this is going to equal the materials used plus wages plus factory overhead. And I still didn't get that right. So let's do that one more time. Total manufacturing cost will be equals materials plus wages plus the manufacturing overhead. And that's what's in our problem. Next, we add in our work in process at the beginning to get total manufacturing cost to account for. So total manufacturing cost these are costs debited to WIP for the period only. Work in process at the beginning is going to equal, right from our T account, 150. Total manufacturing cost to account for will be the total beginning WIP plus total manufacturing costs. Right there. So total manufacturing cost to account for will basically be debits on WIP account. WIP ending balance gets subtracted. So equals account for minus work in process 1040, and that ties exactly to the credit on the WIP. Going towards the income statement, you're going to start out with cost of goods manufactured. This is the cost of goods sold section of the income statement. Finished goods inventory beginning is right in your T account. Cost of goods manufactured is right from your statement. And if you ever got one of those trick questions on a problem or an exam where you didn't have this information available, but you had it in a T account like that, you would know that the credit to the WIP is your cost of goods manufactured, because that's your debit to your finished goods. Cost of goods available for sale are these two added together. Then we subtract our finished goods inventory at the end of the period, which equals 175. So your cost of goods sold is going to equal cost of goods available from sale minus your finished goods inventory balance of 1112, and that's always going to be your credit to your finished goods and your debit to your cost of goods sold. So this debit cost of goods sold equals your schedule. So the point I'm trying to make is that the cost of goods manufactured statement is really nothing more than debits and credits of inventory accounts, which represent the cost flow of your manufacturing costs, whether they're direct or indirect, overhead, variable, fixed. Don't get confused by all that. Just worry about your debits and credits. A good job cost example in homework basically gives you the practice of this. That's all this statement is, and you literally can prepare that statement from your T accounts with your debits and credits. The key to know is that your credit and WIP is always going to be your cost of goods manufactured, right here. So if you go to problem 358 or any problem, and you want to become really good at that, if you're studying for the CMA, I suggest a couple times you just take all this information and flow it through your T accounts. And then do the setup of the statement, which I did, and you'll see that it's very logical. So that concludes our problem 358. I hope you got some of the logic, and I hope that the T account approach makes it much more logical and rational for you. And the good old T accounts always work. We're going to be taking some of this approach also when we do process costing. We're going to use some T accounts to show the logic with process costing, because the statements are rather a little bit on the confusing side. So when you see it flow through a T account, to be exact, a WIP inventory account, you will see how it gets transposed to a statement. So that concludes our problem. Thank you.